Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. It is Culture Day in Japan, so a market holiday, and we will have no trading in U.S. Treasuries until the London session. Elsewhere over the weekend, OPEC Plus said it will make a modest increase in oil production next month, but then the cartel will pause hiking output during the first quarter of the new year. Oil prices are trading higher this morning. And we're getting some PMI releases across Asia. That would include South Korea and Taiwan. For a closer look at market action across the APAC, I'm joined by Paul Dobson. He is Bloomberg Executive Editor for Asia Markets. Paul joins us from our studios in Singapore. Thanks for making time. Can we start with the PMI data? The South Korean number dips into contraction if you look at the manufacturing PMI. Taiwan, a bit stronger than the figure that we had in September. I know that there are very different themes here across these jurisdictions, but can we begin to paint with a broad brush? What are we seeing in the PMI data?
Hi there, Doug. I think that one thing to keep in mind is the backward-looking nature that we have for some of the data compared to the agreements that we've seen with Trump's visit over the past couple of weeks. And I think that that will give people renewed confidence in the outlook for the economy and particularly for exports going forwards from here. So that might make everything a little bit more tricky to sort of cut through the noise on. On the whole, if you look across the Asia sector, PMIs are mostly in positive territory and exports have been holding up relatively strongly as well. A lot of it anchored by China, which has been, continuing to sort of set a path for that 5% growth target too. At the moment, it seems, I guess you could wrap it up as being sort of steady as she goes in some ways. Nothing to particularly worry about at this moment in time.
So, Paul, I'm glad you mentioned last week's agreement between Presidents Trump and Xi when it came to trade. So China, we know, will terminate investigations targeting U.S. companies in the semiconductor supply chain, and Beijing will also suspend implementation of additional export controls on rare earth minerals. Now, for the Trump side, that's a big win. Now, from the U.S. side, the Trump administration is going to pause some of those reciprocal tariffs on China for 1 year, an additional year, and at the same time, the U.S. will halt plans to implement that 100% tariff that was floated on imported Chinese goods. But I'm wondering, is it too much to say that perhaps Beijing got the better part of this deal?
I guess you could probably sum it up that way. I think that China was able to show that its policy for escalating rather than backing down and negotiating immediately with the US paid off to a certain extent. And I think that the longer term view is that China is certainly in a much stronger position for these trade negotiations this time around versus where it was in the first US Trump presidency. And I think that, they're pretty cognizant of that. They know now that the rare earths and the critical minerals can be a pretty strong leverage point in the trade negotiations. There's also some biotech and pharma related goods that haven't been brought into the equation so far that could also be another lever that China could pull. But, on the flip side of that, China wants stuff as well. It wants, more access to the US technology that it's being shut out of at the moment. So I think both sides were able to bare their teeth, but both of them were able to come away with pretty much what they wanted, which is that compromise, that pushing things forwards a year, both on some of the technology stuff and on the rare earth stuff, and keep them going on this path that seems pretty clear to everyone, as Besson would describe it, not decoupling exactly, but de-risking or, strategic sort of separation. And so the US will be on the hunt for rare earths and ways to get out of that China supply chain, and China will be continuing to push its own technological and industrial development to try to get away from the US dependence as well.
Well, I'm glad you referred to the Besson comment there of not wanting to decouple but trying to de-risk. And I would argue that that's something that Beijing has been doing for a while when it comes to the U.S., right?
Yeah, I think so. I was trying to characterize it the other day as a sort of amicable divorce, so long as there's not too much disagreement, then they can kind of split up and move their separate ways. And it's complicated because there's, like if you extend the metaphor a little bit, there'll be some arguments over who gets custody of certain goods, certain ownership, certain property rights, and those kinds of things, certain relationships with third parties as well, who stays friends with who and stuff like that. But yes, China has definitely been on this route, but also the US has been on this route for quite a long time as well. It became kind of clearer over the last 5 years that there's a need to, reimagine all of the supply chains, and COVID really threw that into very sharp relief. And ever since then, that's been that sort of path that we've been on. I think that what it looks like longer term isn't just, China and US moving apart, but as I said, who takes what with them. And China is doing a lot of diplomacy in order to try to, make sure that it has a larger sort of zone of influence that sort of splits off from the US, or at least leans more towards China. And so, that's interesting and could be troublesome economically, or could, further sort of fragment trade routes and trading as well. And so therefore have some impacts on financial markets in the economic outlook long term. But it's very hard to figure out exactly what that course is going to look like from here.
So help me understand what your team is going to be focused on in the week ahead, the stories in the APAC that will be particularly important for markets.
Yeah, the stories in the APEC are not that different from the global themes. I think more important than anything else is still the tech story and whether that rally can continue going. We saw, the Nasdaq had a good day on Friday, lifted by Apple and Amazon. So that set us up a little bit more positively for the week ahead. I know Japan is on holiday today, but the Nikkei just had its best month in 35 years. So the tech story there flying ahead, but also Takaichi seems to, the new leader in Japan seems to have had a really good couple of weeks of diplomacy, getting photographed with all of the leaders from around the region and really sort of establishing herself, and her popularity ratings have shot up as a result. So, giving Japan a little bit more of a confident direction may be interesting. On the flip side of that, though, the yen has been under a lot of pressure. That's been one of the bigger movers as well for us. Weakening against the US dollar is the sort of flip side of the stocks are gaining in some ways. So I think Japan is going to be an interesting one to focus on this week, as well as keeping an eye on China, and then keeping an eye on what global central bank policy is going to look like, with the Fed path a little bit less clear after what we heard from Jerome Powell at the end of, or in the middle of last week. Yeah,
he went on to say last week that it's not a foregone conclusion that the Fed is going to cut at the December meeting, and we have the BOJ still a little reticent toward the idea of raising interest rates. Is that pretty much the dynamic that will continue now for the next, or for the foreseeable future?
Yes, I like to joke, rather than always going on about the taco trade, it's the BOJ that always chickens out. Whenever they get that opportunity to raise interest rates, they seem to shirk it. And so we're still waiting for them to move again. The thinking is that, wait until Takaichi is in place. Don't move too fast, given she wants to think about what she's going to do in terms of fiscal stimulus and economic stimulus. But at some point, the BOJ should be raising rates, and that should give the yen a little bit more support. It's just, it seems to always be pushed off into the long grass. And as you said, on the Fed side, I think it's really interesting because we heard from 3 policymakers at the end of last week all telling us why they didn't want to cut interest rates at the last meeting. I mean, they did anyway, and they voted for it. But, the fact of the matter is that they're getting a little bit more noisy in their complaints, and that split among the FOMC is going to get wider, it seems like, which will make it very difficult for Powell to kind of tread a middle path.
Okay, Paul, we'll leave it there. Thank you so much. Paul Dobson, Bloomberg's executive editor for Asia Markets, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Earnings are very much in focus. Now, in the week ahead, we'll hear from a few big U.S. consumer names. Last week, of course, big tech was in the spotlight. We heard from 5 key players. Earnings growth outpaced estimates. Quarterly profit growth tracked at around 27% for the entire group, for those 5 companies. For a closer look now, I'm joined by Carol Schleif. She is the Chief Investment Officer at BMO Capital Management. Carol joins us from just outside outside Minneapolis. Thank you for making time to chat with me. I'd like to begin by getting you to break down for me what you heard from Alphabet, from Microsoft, Meta, Apple, and Amazon, and what it tells you about the current AI trade.
No, I actually think if you step back and you look at it, you've got companies, many of them 40 or 50 years old, that are still generating billions of dollars in revenue, growing business 20 to 40%. So overarchingly, if you step out of the sort of quarterly numbers and look at the trend, it's still very much intact with very vibrant companies contributing a lot to the GDP and the economy. And it's tough because investors, you could tell, and investors are very focused on short-term issues. You saw some volatility in the stocks both up and down. And even when companies met so-called expectations, if they didn't knock the cover off the ball, which I think was a little unrealistic, the stock prices moved in those directions, but these companies are still very much operating from a position of strength, if you will, and they're producing it out of legit businesses.
When you look at the level of expenditures that these AI companies are going about right now, and I'm wondering whether there is enough evidence in your mind to justify the valuation and to bet on a near-term reward.
Well, I'm not sure we're necessarily betting on near-term rewards, but I think the other thing is that's where you broaden it out in terms of our companies in general, because we're in the process of another big shift, much like as we introduced the internet itself. And then it took a while once the internet was there, because you think about the late 90s when we first started talking about a lot of the dot-com stocks then, and we were doing the infrastructure build-out. But it really wasn't until almost a decade later when we had storage all of a sudden get very cheap, and we had the iPhone invented, and we all went mobile. So it took a while to get all of the use cases put together. And as long-term investors, I think that's what we're focused on. And you've seen companies actually have been using AI internally and creating test cases for it, or use cases for it, for a very long time, a lot prior to the introduction of ChatGPT. And so you had some companies. There was a big logistics company here locally that the stock performed very well because they were showing how they were using AI in the ability to adapt supply chains. And so there's a lot of that going on. And as investors, as long-term investors, the AI and the tech build-out is one piece of it, but there's also a lot of tangential stuff going on in terms of healthcare is using it, financial services is using it and backing it. And you've also got a whole variety of companies that will benefit from it.
So last week, Carol, as you know, NVIDIA made history when it became the first company ever to have a market cap of $5 trillion. Obviously, this company is at the heart of the AI revolution. Interestingly, I was reading a piece over the weekend. Researchers in China have developed a new analog chip that they say is 1,000 times faster than the high-end NVIDIA GPU. And I'm wondering whether I understand the influence that NVIDIA has right now on the AI story, but the question is whether there is some risk, minor as it may be, of a sort of complacency, that we need to be on alert for a potential threat to NVIDIA's dominance.
Yeah, I definitely think that's the case in terms of picking a horse to ride on, or a single stock. I mean, you've got Mag 7 participation just in a passive index. You've got massive participation there. And so leaning into some of these other things, because the other thing is, in a lot of those companies, as well as the government and other entities, are looking to invest in quantum computing. And there's a lot of stuff in quantum where, if and when that breakthrough comes, there's estimates that it could come in 5 years. There's estimates it might take 30, but who knows when it comes. But when it does, that changes the game again and shifts the trajectory. So I think the bigger theme is to figure out which companies, no matter what industries they're in, are leaning into being adaptive and being able to not shift on a whim, but being cognizant enough of the way technology is evolving, because we are in a whole new age here and being able to lean into that and not necessarily pick one particular company that's going to be the harbinger of that, but understanding that there's going to be a lot of different ways to play it. And there's all kinds of different ways to play it these days in terms of different technology ETFs and things like that. And, the one thing we haven't even talked about is when you start talking about defense, there's lots of overlays in defense. There's overlays in logistics. There's overlays all it'll touch every single aspect, not unlike when we all came off the farms and were able to go to the city because there was electrification and indoor plumbing. It sort of changed everything.
So I mentioned a moment ago that we'll hear from a few U.S. consumer companies this week. To what extent do you believe the strength of the American consumer is really about the wealth effect right now?
Yeah, there's a big piece of that, but the wealth effect isn't just the market. It's a big component is the market, but it's also housing values and things like that. And we wrote about it a couple weeks ago in terms of, everyone talking about you've got not only the K-shaped economy with the top 10% generating fully a third of GDP and half of consumer spending, but you've also got different demographic cohorts, and those are important to watch too in terms of the way they plug in, not only to investing and participating in things, but the way they purchase and where their sensibilities are and things like that. But that bears a lot of watching, and I think a lot of traditional old line companies, particularly staples, are having trouble keeping up with some of that because you've got the impact of the way consumers are spending. Yes, they're feeling better about spending because of where markets are, but you've also got that top tier that is less impacted, if you will, by employment trends and a lot more impacted by the fact that even if you had a pullback in markets, they've still made significant gains over the last 4 or 5 years in their portfolios.
So last week, Carol, we heard from Fed Chair Jay Powell. He seemed to push back on this idea that a December rate cut was a foregone conclusion. There are many voices at the Fed that seem to be a little concerned about how sticky inflation has become. It's rising a little bit, and inflation expectations are also picking up just a bit. Where are you right now in looking at inflation, and help me understand how that may influence your thinking as to what the Fed does next?
The interesting thing is like the Fed's so wedded to 2%, but the markets did, the sort of average or typical rate of inflation post-World War II was closer to 3 to 3.5%. And we're all arguing right now about whether it's 2% or 3, getting to the Fed's 2% or whether 3% is tolerable. And the fact of the matter is these companies are still generating some pretty great revenues with inflation as sticky as it is. So, it remains to be seen if they cut or not in December. You've got, as much as they don't want it to creep in, politics are creeping at the edges of it in terms of some of the governors, and you saw that. It was the most adamant I've ever seen Chair Powell be about the fact that there was a lot of dissension in that meeting, clearly, that there was probably more heated interaction. And, I'm sure it was respectful, but just very strong opinions on both sides in terms of whether they should cut or not. And we honestly think the markets, the Fed's important, but it's also important to remember that something like 80% of lending happens outside the regulated banking system now. It's really moved. We've disintermediated a lot out of the banks. So while the Fed has important overtones psychologically to things, the bond markets are moving very carefully in their own sphere, if you will, and they're watching company debt. I think the bigger issue for us that we're watching, especially as it relates to fixed income markets, is how does all the data center spending get funded? Because a lot of it has been funded out of cash flow now, but now you've got an increasing amount that's being funded both debt on and off the balance sheet. And so there's a lot more dynamics that will impact stuff. And the faster we get excess compute capacity out there, the more deflationary impacts that has. And to the extent that, if tariffs stay sticky, that has a tendency to reduce demand somewhat, which would also have some deflationary impact. So there's enough on both sides of the ledger to mean maybe we stay stuck around 3%, and I'm not sure it really matters for earnings and for the long term.
So before I let you go, Carol, give me your sense of what's happening in the private credit space right now. Should we be worried?
I think we should be watchful. We should be really watchful because you've got a lot of companies out there playing it. And in my mind, one of the things I'm most watchful for is between a lot of the big private credit companies funding the big, important technology companies, do we create entities so big that in and of themselves they're too big to fail? Because right now, the advantage to all this spending has been, well, the taxpayer's not going to have to bail anybody out because they're all doing it out of their own cash flow. Well, if banks are backing big private credit companies and the private credit companies are in a circular manner funding technology. Now, I think we're years away from that, but it's one of those things where we're trying to watch it pretty closely on the margin where we can and try to pull numbers together and make sure that we're keeping an eye on that, because that to me would be where things could get funky.
Okay, we'll leave it there with things could get funky. Carol, thank you so much. Carol Schleif, Chief Investment Officer at BMO Capital Management, joining from just outside Minneapolis here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.